Hi, Matt McAleer, Director of Equity Strategies, March 20th. Back with you for the second time this week, and you know that's not good news. Mentioned last week that we'd try to get on more often if there was a lot of volatility in the market. We're on with you Wednesday. Still heavy liquidations, really across the board in multiple asset classes. And that's the concerning part. That's the part we really need to respect, the fact that it's not just equities or just fixed income or just commodities, but that rush for cash in the form of short-term treasuries. So that's something that continues to jump up, bother us. If we are looking for anything on the positive side today, Friday, maybe we look at the VIX coming off those highs. Traded to 80 the other day, even with the weakness between 3 and 4 p.m., which probably, as we know, if you traded for some time, is that 2 o'clock witching call is margin time. So we tend not to want to nibble in the morning or chase in the morning. We want to see how the market treats margin calls 2, 3 o'clock. Couldn't handle it, backed off. What we get in there is some cleansing. If there was a positive at all, is that the VIX traded back up to 66, 67. The negative being that it had traded under 60 early in the day. Now, I'm half shocked that I'm talking about the VIX trading down to under 60 because we've had such a non-volatile market for a while that the VIX up through 40 and 50 was a big red flag, something that jumped out at you. So we're talking about extreme volatility pushed by extreme panic readings straight across the board. Often in the equity markets we can point to something, and we can certainly point to the unknown of the virus. That's stoking fears not just within markets, which we can tend to surround, but in terms of society. So we're trying to measure that. We're being very patient with our cash. Keep in mind, clients are either a fully equity type of client or a balanced client or a fully bond client. Most clients are a blend, a balanced type client. You'll see cash in those accounts. I mention that because we've gotten some questions when I mentioned that we're 20-30% cash in equity accounts. We've had a couple of calls and a client will say, well, I'm only 12 or 15. Keep in mind, if you're a balanced account, the fixed income portion will take 40 or 50% of the account. So your cash piece from equities won't be 20 or 30, it'll be 10 or 12 or 15 or 18. But we expect the bonds to be treated as a cash flow instrument and thus dampen the volatility. So, what have we done wrong so far? Again, everything's crystal clear in the rearview mirror. What have we done wrong in February, early February, when we started raising cash? We didn't raise enough cash. We didn't raise cash quickly enough. We got to that 20, 22, 23% in a couple of the strategies. Obviously, in hindsight, needed more. What have we done right? We've been very stingy with that cash. Patience. We've let the market rip and run and fall and shake people out. We still have that cash piece. In the balanced accounts, we still have a large piece of pre-refunded short-term municipal paper, and on the taxable side, taxable floaters, shorter term paper. That can all be used to adjust portfolios as we go forward. Always important to respect your allocation, understand what the capital is designed to do. So we don't know if next week, next month, next year is a bottoming action in equities. What we do know, there'll be plenty of opportunities intra-week, intra-month, intra-quarter to make reasonable bets on different securities. What are we looking at? I don't mean to be a broken record here, but I think you really have to get into your trading pattern that you want those great balance sheet dominant names. You want to be bidding for stock, if you're in the market here, underneath the market. I've been talking about this for a few weeks now. Do not chase this market. Yeah, let volatility work for you. That 8, 10, 12% volatility during the day, you need to put that on a positive and treat that as a friend for you. If Microsoft is trading at 145, and by the way, we're long Microsoft, and I want to add to my Microsoft position, I'm bidding at 132, 134, 135. Let them come. If they hit me on Microsoft at $1.33, God bless them. I'll own Microsoft for 5 years. That's what you have to be thinking. If you don't want an equity that you can own for 1, 3, 5 years, don't bid for it. That comes from trading these kind of markets, not quite with this kind of fear, but clients know through 08, through 01, through 98, the way you make real money 3 and 5 years out is bidding and let the panic come to you. But bid below the market. Do not chase. The Moose, John Mousseau, is going to give you a little bit of update on the bond market. We will get through this. We always do. We respect risk, but we can't take our eye off reward. Don't just be fearful. One quick note, we have been working remotely. Many of us are in the office, but that's going to be due to change for safety reasons. Hurricanes have given us great redundancy and practice with our remote trading and operations. So contact us normal way. We'll be working hard for you all week. Speak to you soon.
Hi, I'm John Mousseau. I am the CEO and President of Cumberland Advisors and Director of Fixed Income. And it is Friday, March 20th, and TGIF. It has been one heck of a long week. I want to give you a little bit about bonds. Today you saw the classic move towards lower Treasury yields with the 10-year Treasury back at an 85 basis points, the 30-year bond back to 140. Remember, these were much lower and then went much higher and have now come back down. Yields on other instruments, corporates, tax-free bonds, taxable muni bonds, high-yield bonds, all much, much higher. It is the classic run from risk. Run into treasuries, run away from everything else. Did the baby get thrown out with the bathwater? You bet. If you don't believe we're going into the Great Depression of 1929, and we do not, then you take action, and that's what Cumberland is doing. So we are selling some shorter-term bonds, things like pre-refunded bonds, short-term notes, buying longer bonds, 4%, 4.5%. We bought some AA bonds today. We're going to continue to do this. We're going to be locking in yields which are not only the highest we've seen in well over a few years, on a relationship to treasuries as cheap as we've ever seen, even going back to the 2008 crisis. Is this an opportunity? We think so. Why? Because municipalities do not go out of business. The historic range on this, if you wanted to go back to the Great Depression, is that very few municipalities went out of business, and those that did resumed paying and paid off their debts. Only a few Dust Bowl towns actually defaulted and never paid back. Everybody else eventually came back. You're buying high-grade utility-type bonds, water, sewer, things like that, high-grade GOs. That's what we're buying. We're drilling down on credit in all of our portfolios, but we think this is a great opportunity. And I want to add one other thing. We saw the Fed today put credit facilities in for some of the municipal money market funds. We think that's very important, where if they are getting shredded with redemptions on money market funds, that they can turn to the Fed for some financing out of there, pledging some of their other bonds as collateral. That's very important. We also think that the Fed may institute their Rule 14.2b, which actually allows them to purchase directly short-term municipal securities inside of 6 months. What does that do? That puts the Fed into the municipal game and will start to calm the markets down. So we think this is a heck of a chance. We don't know whether the Fed's going to do that. We think they might do it. But in any case, we are taking constructive measures to lock in 4% plus yields in a time period which is clearly disjointed and where bonds are being thrown out because of the redemption of bond funds and just thrown onto the market. And we were defensively oriented as we went into this. We didn't think we would get the straight arrow shooting up in yields that we've gotten, but we're taking advantage of it. And we want everybody to have a good weekend and know we're hard at work next week here at Cumberland, whether we're here or working remotely. Thanks and have a great weekend.